All right, let's talk about Sphere Entertainment because they just dropped one of the most confusing earnings reports of the quarter. The headline number looked like an absolute grand slam, but the stock ended up striking out for the day. So what on earth did the market see that the headlines missed? We're going to break it all down.
Okay, so here's how we're going to tackle this. We'll start with the top-line numbers that got everyone talking. Then, we're going to peel back the curtain on that headline beat. After that, we'll dive into how the Sphere is actually operating, check out how investors reacted, and finally, I'll give you our take on what to expect next.
First up, let's look at the numbers that had traders buzzing before the market even opened.
And right away, you see this massive disconnect. The company posted earnings of over $3 a share, when Wall Street was expecting them to lose about $1.50. That's a nearly $5 beat. It's huge. But after that initial pop in pre-market trading, the stock did a complete 180 and closed down 4%. What gives?
This really brings us to the key question here. How does a report that looks this good on the surface get sold off so hard? Well, as always, the devil is in the details.
So let's get into the nitty-gritty. That massive earnings number? Yeah, it wasn't exactly what it seemed to be.
So you have this number, right? Positive $3.39, an absolutely astronomical beat. But the most important question you have to ask is, where did that profit actually come from?
And here's the kicker. This windfall didn't come from selling more tickets to Dead & Company or booking a ton of corporate events at the Sphere in Vegas. Nope. It came from a totally different part of the company, the legacy media business.
Here is the real story. The entire earnings beat, and I mean all of it, was thanks to a one-time, non-operational financial maneuver. They restructured some debt over at their declining MSG Networks business, which created this huge paper gain. Look, it's a smart move for their balance sheet, but it tells you absolutely nothing about the actual health of their core business, which is the Sphere.
Okay, so if we just ignore that bit of financial engineering for a second, how did the company's real operations actually perform? Let's take a look. I mean, look at this. It's a classic tale of two businesses. Revenue from the actual Sphere venue in Las Vegas, it grew a really healthy 16% compared to last year. That's good stuff. But at the same time, the legacy MSG Networks segment just keeps on shrinking, down another 12%. This is the underlying trend that serious investors were focused on.
Now, on the earnings call, management was obviously very positive about the Sphere itself. They talked about how the calendar is getting much busier, new shows are driving future ticket sales, and they're even making some headway on expanding globally. They even floated this idea of a smaller, cheaper-to-build Sphere model, kind of like a franchise. This is the growth story they really want you to buy into.
You know, CEO Jim Dolan gave us a really fascinating peek behind the curtain on their strategy. He basically said they intentionally create a bidding war for calendar dates. They put concerts, corporate events, and their own shows in competition with each other. And who wins? Simple. Whoever is going to make them the most money on any given day. It's a purely ruthless focus on maximizing profit. So when you put it all together, you've got this messy headline beat, but a pretty solid story at the core venue, all while another part of the business is in decline. How in the world did the market digest all of this?
The stocks chart for the day tells you everything you need to know. First, before the market even opened, the algorithms see that huge EPS beat and bam, the stock shoots up over 11%. But then, as human analysts actually read the fine print and realize where that profit came from, the rally completely evaporates, and the stock ends the day deep in the red.
And this leaves us with a really clear-cut debate. The bull case is pretty straightforward. Look, this is a one-of-a-kind venue, demand is strong, and there's a huge runway for growth. But the bear case is just as simple. Can this business model ever generate a decent return on investment, especially given the insane construction costs?
So, the billion-dollar question is, where does the stock go from here? Based on everything we saw this quarter, here's our forward-looking take. We're looking at this in three parts. First, for next quarter's results, we expect Sphere's revenue to keep growing, but we're going to keep a really close eye on their margins as the costs for their new content start to hit the books. Second, as for the stock itself, don't expect a big breakout. It's probably going to be stuck in a range until the company can prove it can generate clean, consistent profits, which brings us to our official rating. We're kicking off our coverage with a market perform rating. The progress in Las Vegas is definitely encouraging, you can't deny that. But the fundamental question mark is still huge. Is Sphere a scalable, high-return business, or is it just a collection of incredibly expensive one-of-a-kind projects?
Until they can prove the model works and can be scaled profitably, the stock remains a show-me story.
And as always, a final reminder. This analysis is for informational purposes only. This is not financial advice.